Hey everyone, it's Jonathan. This is going to be our free video, and I'm going to go over a topic that we discuss often, and it's bond futures. There's a very specific way to trade bond futures, and let me go over an example, and I think you'll see the difference as we go through the example. So in front of you, what I have, guys, for one, I'm looking at Sierra charts, been playing around with Sierra charts, and it's super easy to use. But what this chart is, if we look at the yield curve, and the yield curve is going to say, a normal shape of a yield curve is like that, right? So say there's a 2-year, there's a 5-year, there's a 10-year, there's an 18-year, there's a 30-year. And the future contracts that are associated with these are going to be the ZT, the ZF, which is the 5-year, ZN is the 10-year, the ZB is the 30-year, but it's really closer to an 18-year, and then a UB. So we can trade all these different contracts. Now, where people go wrong trading bonds is they'll trade the ZN or they'll trade the ZB, and they'll make up a bet, and they'll bet on the ZB whether it goes higher or whether it goes lower. And that's fine, but if you're doing this and you want consistency and you want a little more depth behind your trade, this is how I suggest looking at it. In front of you is going to be the ZB butterfly. And the ZB butterfly is going to be ZB. Think of that as the belly of the butterfly. And then the wing is going to be a ZN. And then the other wing is going to be a UB. So this is what the butterfly is. And you'll see on the yield curve, it's this portion. And I charted it right in front of you. And the benefit to charting it is when it gets real weak, like here, the ZB is just lower relative to its two wings. As it strengthens, the ZB is just strengthening relative to the two wings, okay? Think of it like a rubber band. A rubber band is going to pull. I'm no artist, but if this is a rubber band, and we pull, inevitably that rubber band's coming back to whatever normalcy is for the rubber band. And that's a really weird example, but hopefully you're able to follow what I mean by this. So, I'll change my pen again. Going back to 611, if we look at this as kind of like, this is the channel of the ZB, okay? And that's a weird line that I drew, but it doesn't really matter. When it gets really weak down here, that ZB is so unbelievably inexpensive relative to everything else on the yield curve, especially the back end of the yield curve. And when it rallies like this and gets up here, that ZB is way expensive to everything else on the yield curve. Now, I know I did a lot of drawing on this chart, so let me simplify things for you. And let's take all these markings off the chart. Okay, if you need to watch that again, just go ahead, watch, rewind, all that kind of stuff. So I'm going to take all this stuff off the chart. And right now, what you'll notice is the ZB is very, very expensive. And when it gets up here, the ZB is expensive relative to its neighbors, right? We already covered that. ZN and ZF. What you could do as a trader, well, one, you could sell ZB. Just sell ZB outright. At least you know it's definitively the most expensive contract, at least if we compare it to the 10-year and the Ultra. The other thing that you can do is you could sell ZB and buy the two wings. A more advanced trade would be you could sell ZB and then make a decision. Do you want to buy the ZN or do you want to buy the ZF? And the advantage of doing each one of those, and for those finance students or economic students out there, if we look at the yield curve like this would be a flat yield curve. This would say the 2-year is 2% and the 30-year is 2%. Dead flat yield curve. Maybe the 2-year is 2% here and the 30-year is 5%. Or you could even have a downsloping yield curve. Doesn't happen often, but maybe the 2-year is 2% and the 30-year is 1%. Okay, that's a little bit of an extreme example, but understand that the yield curve can do all these different things, and we can take advantage of those plays by finding the most expensive contract, finding the least expensive contract, and trading those together as like a relative value type trade. So I traded these things professionally for 8 years, guys. This is absolutely the correct way to trade this stuff. So if you wanted to play for a steepener, you could buy the ZN and then you would sell the ZB. If you wanted to play more for a flattener, then you could sell the ZB and buy the UB out here. 2 different ways to do the trade. There's a lot of different ways to do the trade. And the benefit of trading fixed income like this, I mean, obviously it needs to be learned, right? This is probably very, very overwhelming. I just want to show you the possibilities of what you can do with this market if you're willing to put in the work. And that's what it really comes down to. Just like your business. I can't go learn your business in a day or 2 days. It's going to take me 6 months, 18 months, however long it's going to take. My profession is the same thing. You can't learn trading in a week, 2 weeks. You have to invest your time. But if you do, this is a really, really cool trade to learn. And if you're interested, reach out. Jonathan at Active Day Trader. I'm more than happy to help you. All right? Hope this helped, guys. Jonathan, Active Day Trader.